Most retail traders validate a strategy by picking a single parameter set that performed best in sample, and then checking how that one set behaves out of sample. It's simple, it's familiar, and it's also one of the biggest reasons retail strategies fail in live trading. In OMS, you now have access to something far more powerful: walk-forward correlation, or WFC. This is a professional-grade diagnostic that evaluates the entire optimization surface, not just one cherry-picked point. It tells you whether your strategy has genuine, persistent, forward-looking edge. When you choose a single best parameter set, you're basing your entire decision on one data point from a much larger parameter space. If that one point performed well in sample by chance, and this happens far more often than traders realize, then your whole evaluation is built on noise. The problem might not be the strategy, it might be the method you're using. You're making decisions based on single data points which carry very little statistical significance. Walk-forward correlation fixes this by analysing the shape and behaviour of the entire optimization surface, which is statistically far more reliable. It reframes the validation as a surface-wide inference problem. Instead of asking the question, did this one parameter set work, walk-forward correlation asks, does this strategy behave consistently and predictably across the whole parameter space? If the answer is yes, you're looking at structural edge. If the answer is no, you're looking at instability, overfitting, or simply a strategy without reliable forward-looking behaviour. The first component of the walk-forward correlation framework is quadrant analysis. Every point on this chart represents a full optimization run for a specific parameter set. The x-axis shows its in-sample performance, and the y-axis its out-of-sample performance. You can change which performance metric you want to use to display this information here. So you can choose, for example, the Sharpe ratio, profit factor, or return over drawdown. You can even use our combined metric that blends several different characteristics of performance into a single metric. All values are normalized so that 0 represents break-even performance, which makes the quadrant boundaries meaningful and allows direct comparison across strategies. The space is divided into 4 quadrants. Upper right, or ++ indicates where performance was good in sample and good out of sample. This is the behavior we want, and it indicates structural edge in your strategy. Upper left, or -+ is much rarer. It's where the strategy performed poorly in sample, but then unexpectedly performed well out of sample. This can indicate a regime shift between the two periods, which of course is really important to know as you decide whether to trade your strategy or not. Lower right, +- is where parameters performed well in sample, but then failed out of sample. And this is the classic signature of overfitting. If you have a high proportion of parameter sets in this quadrant, you need to consider if you attempted to optimize too many parameters, meaning the strategy was able to fit to past noise in the in-sample dataset instead of identifying genuine structural edge. Lower left, -- indicates parameter sets that were poor performers both in sample and out of sample. It's absolutely fine to have some parameter sets here, because you would never select them anyway. But if the majority of your parameter sets fall into this quadrant, the strategy simply lacks viable edge and will not be able to extract alpha from the markets. Quadrant analysis gives you an immediate intuitive sense of the optimization topology. If most points sit in the upper right quadrant, the strategy has consistent edge. It means that selecting a strong in-sample parameter set gives you a very high probability of strong out-of-sample performance. If points, however, scatter across all 4 quadrants, the strategy is much more unstable, even if the best in-sample parameter set looked amazing and fooled you into thinking you had something robust. For the first time, retail traders can see the entire optimization landscape, not just the cherry-picked winner. It puts you on a level playing field with professional quants and institutional trading teams. But the power of walk-forward correlation doesn't end there. The second component of the framework is Predictive Power Analysis, which measures how strongly in-sample performance is correlated with out-of-sample performance across the entire surface, and therefore how predictive it is. If the optimization surface contains genuine informational content, meaning parameter selection is useful, you'll see a clear positive relationship. On average, when this is the case, the better a parameter set performs in sample, the better it will also perform out of sample. Walk-forward correlation quantifies this relationship using 3 metrics: Pearson, Spearman, and distance correlation, each capturing a different aspect of predictability. High correlations mean the surface is predictive. It contains real forward-looking structure. Low correlations mean the surface is non-predictive. The in-sample results are mostly noise. And this is the difference between trading with confidence and trading blind. With walk-forward correlation, you're no longer guessing. You're no longer relying on a single lucky parameter set. You're evaluating the entire behavior of your strategy across the full parameter space. And so this gives you higher confidence in your optimization results, a clearer understanding of your strategy robustness, protection against using overfitted results, and a professional grade audit trail for your research. Most retail traders never see this level of analysis. It's normally reserved for institutional quant teams, but now it's built directly into OMS. Walk-forward correlation doesn't replace your existing workflow, it strengthens it. It gives you a deeper, more reliable understanding of your strategy's behavior, and it helps you make smarter decisions with far greater confidence. If you're serious about building strategies that survive real market conditions, walk-forward correlation is one of the most powerful tools you can use. And now, in OMS, you have it. Note that we've created a separate video that covers everything you need to know about generating walk-forward correlation data in OMS. So be sure to check that out if you're an OMS user.